Mahindra.
Let's actually bring in Venugopal Garre, right? He's, of course, India Head of Research at Bernstein. Venu, good morning. Great to have you with us here. And Venu, of course, is someone who, I don't know if you still do, Venu, but you looked at autos very closely. I mean, actually, you have a few of those companies under coverage. You were very bullish on M&M a few years earlier. I remember having those conversations. What is your sense, just throwing that discussion to you, what your perspective of this entire Mahindra Tesla reality now here in India? What's your sense?
Thanks, Prashant. I was listening to your Tesla sort of comment on Mahindra. Honestly, it does not matter. Tesla pricing-wise will be at a level at which it's going to sort of target a very, very small market in India. And more importantly, we're not that bullish on electrification in the four-wheeler sort of a space for a fairly long period in India, because I don't think charging infrastructure is ready yet to be able to convince people to sort of buy those products. And pricing-wise as well, if you see, most of the launches, even for the Indian companies, are happening at a premium sort of a pricing. So, this Mahindra stock price, whatever that you see, 1% really doesn't matter. The sort of a decline that you see has nothing to do with Tesla, honestly. It is more about the fact that we're heading into a result season in general, where there isn't much of a positive vibe with respect to margins in general in the sector, Mahindra included. And remember, another aspect of it is things like rare earth supply and potential delay in production for vehicles in general across the board is another thing which is sort of should impact auto companies in general in the near term.
Okay, so you continue to be in the camp, and I think that camp has a lot of followers, that M&M is not going to be directly impacted too much, even with Tesla's entry.
Just for the heck of it, take the other side.
Okay.
Tesla and their team in India obviously know all this, right? That just out of they're priced out in that sense from where the bulk of the SUV buying or whatever that category of consumers is. So wouldn't they try something new? I mean, they surely know this. Or are they planning to sell very few cars in India?
So the reality is this, that if you were to just think about it, we wanted Tesla to come to India, and I don't think Tesla was very keen to come to India. And I think that is
now you put it on its head. Go on, sorry.
Absolutely, that is a reality. Look, China benefited significantly from Tesla's presence in China. A lot of the sort of development that you see in terms of capability building, which happened across the board for a lot of OEMs, from a talent point of view, was to a large extent, I would probably say, also supported by Tesla's presence out there. And I think India needs companies like this to sort of create talent pools and, more importantly, create manufacturing. Remember that we yet don't know whether they are going to bite with respect to creating a local facility out here. So at this juncture, Trump tariffs are also sort of just about looming. So we'll get an idea if anything is sort of happens around that front as well, where you might probably end up being able to import at lower duties from the US, right? And that is probably the positioning that players like Tesla would want to have, even though despite that will be costly or very costly in India. So it's more a distribution gateway for them. And think of it in a different way. When companies like these, even if they think about venturing and creating a presence, they think of 10, 15, 20 years. I don't think investment horizons for anybody is in that time frame. So we'll see what happens 10 years later.
Okay. All right. So let's wait and watch. It's going to be an interesting fight, or an interesting landscape, to say the least, whichever way things go. Venu, hi, great to have you on the show. So lots to talk today. I'm going to quickly get to the FMCG space. Look at Lever, by the way. Lever is the biggest winner on the Nifty right now, 4% up move. Let's pull up a Lever 1 week chart. Lever is the best performing stock on the index this week. Best performing stock on the index in the month of July as well. Now there's a leadership change, but it's not just about leadership, The market is perhaps trying to sense something or smell something, that something is turning finally in FMCG. Do you think this is a bit of a false alarm, or could this be the real deal after I don't know how many quarters and years?
Okay, so interesting conversation. So I had been in a very interesting camp because I was underweight consumption and staples for a very long period of time. Of course, parts and parcels would be buy, auto buy at some point of time, durables buy at some point of time, things like those. But for the first time heading into this calendar year, I upgraded the consumer staples to a neutral. Okay, that is the best rating I could have gone to, neutral, because it's a very costly space with growth to a large extent being still priced in from a valuations perspective, right? But the idea was that I didn't want people to short consumer staples this year. Part of it is because rural data points had started to pick up positively from November, so that gives you a small positive vibe for consumption in general. We've taken a call that monsoons will be decent, that we could have gone wrong on that, but that's also played out at this juncture. And number 3 is tax cuts, which at the margin does lead to some positivity on consumption in general. So these are all the variables which go into relatively positive consumption thesis compared to maybe what it was last year, right? So that's the entire framework with which we work. Now, change of management-led stock price increases and things like that. I don't think those are important, but I don't think that's like the broad driver for what we would have taken a call on consumer staples. Number 2, remember that there have been some positive data points from some companies who have given this pre-quarter updates as well. So that's also sort of rubbing off at this juncture. And lastly, I would say that look, branded companies, especially on the FMCG side, in the medium term is not 10 years, medium term is maybe 2 years to 3 years, will have an impact because their distribution channels are getting disrupted. And I think that is inevitable. So you will see a resurgence or a creation of a much larger pool of brands out here. So it's very hard to take a structurally positive view on some of these larger consumer sort of brands and incumbents.
So you don't expect a meaningful pickup in volume growth this year. Would that be right?
Okay, so I do expect a pickup in volume growth from really bad volume growth last year, right? So that is good enough for you to create some degree of positive returns on these companies. But the idea is that when you see the first sign of, which of course you'll see in this quarter as well, of a volume uptake, don't get carried away. So this is not like the next 3-year re-rating story. Okay, so you basically to book your profits is the view, right? Not today. I mean, I haven't shifted to an underweight yet, right? So that's the way I would look at it. I think there are going to be challenges eventually in a year or so. So let it run up a bit. It can't run up a lot. Sell after that.
Hi, Venu. Good morning. Good to see you, Ben. We've got 2 earnings coming in from the tech pack, both of them from the Tatas. And, it's been a little bit disappointing. The commentary as well, a little bit softish. But, both those 2 stocks, initial reaction is that dip is getting bought into. What's your view on tech? Clearly, commentary is still a little bit feeble. The hope is that we'll see a recovery in the second half of the year. However, some of these stocks, if you compare it to the 5-year or a 10-year, on a valuation basis, there is some support. So your view on tech, and also briefly, I want you to tell us about the valuations on the mid-cap side of things. Because mid-caps always traded a big premium to the Nifty, I think 50-70%. That's come down a little bit, though growth as well has cooled off. So tech and mid-cap valuations. Please go ahead.
Okay. So firstly on tech, this year I had moved to an equal weight on ID services from being overweight in the prior year. Okay. So I was a bit nervous about anything to do with US. So it wasn't about just ID services. For healthcare, I had moved to an underweight beginning of the year, right? So both have exposures to US. Now, having said that, there was a lot of concerns around lack of visibility for corporates, discretionary spending was an issue. Then there was another layer of challenges around AI and how it could sort of impact the ID services pack and things like that. Too many variables to essentially focus on. So we decided to neutralize a portfolio beginning of the year. Now, what we see from companies reporting at this juncture, 2 of the companies that you mentioned, TCS was like, yeah, I mean, you can argue that wasn't really a great quarter. But beyond a certain stage, I don't think one should have anticipated a great quarter to start with. Auto ER&D companies, especially the one that reported, and the others that you will see will have muted numbers globally. Autos, we've seen some challenges for the last couple of quarters anyway. So that's not really a major surprise that way. But going forward, what I'm actually looking forward to is at what stage to move from a neutral to a positive view. Now, what to me is important is how does the US economy shape up, for the rest of the year and let's say first half of next calendar year. And I would probably argue that US economy is essentially not in a bad shape. If you look at the tax, the big beautiful bill which has been sort of announced, in some way it's effectively a transfer of money to consumers out there. And to push for capex from corporates. These are all like positive things. They've also going to be expanding some expenditure on the defense side, where there's a lot of play for ID companies, etc. So I'm of the view that we're probably scraping the bottom, for this sector in terms of sentiment and absolute numbers. Things might look up later in the year. I haven't really proactively yet moved into a more positive view at this juncture, but I would watch out for that.
So still underweight on IT, right?
I mean, I cut it from an overweight to an equal weight in January, so that itself is a good enough sign that, I turned sort of cautious. Let me put it this way.
And mid caps, very quickly, how are you feeling about it?
Mid caps were trading at a 75% premium to large caps in June, July last year. They are now at 35% premium. I mean, anything around 10 to 15% premium is amazing. We're not there yet as yet. So we're not like literally cheap, but I think 35% premium is fair enough, because if you look at the earnings for differences is justifies that sort of a premium. So we neutralized a mid cap to an equal weight about a month back, compared to being underweight related to Nifty for over a year. What it means is I would proactively look for opportunities, but with relatively lower expectations for returns, because it's still like costly. So that's a broad view on mid caps. I'm not completely against mid caps anymore.
Yeah. We've discussed two large sectors, Venugopal, FMCG and IT, and both, you've got similar views that you're watching very, very carefully to see there's some sustained, meaningful pickup, at least at the end of the negativity. I think FMCG is a little better. That's neutral for you. Let's see if IT can at least, as you're saying, it's the bottom pretty much, will really help the cause for the index overall as well. Thank you so much for joining in. Great conversation. You have a good Friday, and we'll look forward to connecting again soon.